Hello and welcome to our today's session. We'll be continuing our discussion on risk analysis as regards to capital budgeting decision or as regards to investment decision. Previous session, I had told you what is the meaning of risk. Here, risk stands uncertainty in the sense if there is variation in the expected return in financial management, we call it as risk. That means what you are expecting and what you are getting, they are different. And the variation among these expectations, among these actual results. You can say there is a risk in the project. Risk will be there in any investment decision. Risk is involved unless something you are investing somewhere in the risk-free securities like central government securities, like treasury bill, etc. Risk will be there. Now, friends, let us continue our discussion. So, as we have already seen the some of these slides in our previous class, we had discussed what is risk, where several outcomes are possible. And it is different from the expectation. One can say risk is involved in that kind of project. And we have seen there are two broad way of measuring risk. One is a range of return. We can find it out. The difference between highest and lowest return. If the range is wider, risk is more. Other way is that you can calculate the variance or standard deviation. Standard deviation means deviation from the standard. Standard, we call it as what is expected return that may be called as the standard return. Expected return means the average return. So previous class, I was showing you this example where let us say these are the possible returns which are there in the second column. Return X. You see, these are the possible return. If you see average return is 90. So one can say this is standard, or you can say I can expect 90 average return. If I'm getting 6, there will be deviation. The deviation will be minus 30. I'm expecting 19, but getting 6. Deviation is minus 30. Like his deviations are computed. So this is return, possible return, these are deviations. And the returns are attached with some probability. So there is a possibility, there is a probability that 6% return will be, or 6 rupees return possibility is 5%. 12% returns probability is 20%, like this. So these probabilities are there. So this is the return, this is deviation. Then we are find squaring of the deviations, because risk means both positive deviations and negative deviations, both are risk. So we want to eliminate the negativity from the numbers. So we are taking the square of deviation. Then finally we are calculating PD square, that's probability into deviation square. And we are calculating the summation of PD square, the probability into deviation square total. And thereafter, we're taking a square root of that. We are finding out standard deviation. This is a, you can say this is a statistical way or technical way of computing the risk associated with the project. To compute risk like this, you need to know what are the possible returns and what is the probability of possible returns. If you know this thing, then you'll be able to compute the risk. Well, friends, this is similar way we have done it for another project. You can have a look. You can pause the screen. You can also check the calculations and find out how this standard deviations are computed. And in two projects on the basis of standard deviation, you can select a particular project. Here in this case, project A has got low risk, therefore this should be selected. This is a basic understanding. There is another way of measuring, not exactly measuring, selecting project. We can say coefficient of variation method. Here what happens, it's a relative measure. So here in different projects, we calculate standard deviation and we divide by the expected value of the cash flows. So we get the coefficient of variation and we compare this CV or coefficient of variation among various projects where we get better CV. We select that project. That is a simple logic. You can read this slide. Now coming to risk analysis, there are various techniques. But before going there, we also need to understand the type of risk. There are certain risks which are specific to the project called as standalone risk. There are certain risks which are associated with the company or with the firm. We can call it as the corporate risk or within firm risk. There are certain risks which is embedded in the system. It is in the entire system. This risk is there. So it is not possible to control that risk. That is called as the systematic risk or market risk. Okay, now coming to techniques of risk analysis. First technique is the judgmental evaluation. Okay. Here what will happen? The finance manager takes decision without applying any formal method. He in fact evaluate. This should be judgmental evaluation. That means he's evaluating the project on the basis of risk. So he feels that this project has got more risk, that project has got less risk. On the basis, he uses his judgment skill and he selects a project. Payback period method is another technique. Here, what happens? Here we compute that when uh, the initial investments will be recovered, or you can say how fast my investment is getting recovered. Suppose in a particular project, my initial investment is recovered in 5 years, another project is recovered in 10 years. So it is natural to think that when recovery is fast, risk is less. Longer the period, risk is more. So this is called as the period method. Okay. Risk profile method. Here what happens, the profitability distribution of net present value is transformed into profitability distribution of profitability index, which is a relative measure. Here what happens? Suppose you are computing the net present value of the project. You might be knowing what is net present value. That the present value of inflow and present value of outflows are netted off. If it is giving positive value, then project is selected. But net present value is an absolute number. NPV is positive 5 lakh, 10 lakh, like this it is called. Okay, now this is transformed into a probability distribution of profitability index. What is profitability index? Profitability index is a ratio, present value of inflow, present value of outflow. Okay, now what is the probability? Let us say profitability index is more than 1. That means inflows value is more than outflows. But what is the possibility? The profitability index will be 2, 3. We have to attach the probability. Then on that basis, we'll be taking the decision. What is the probability of uh, profitability index will be more than 1? So essentially, you're creating a profile of this thing, that the probability of it is 1.5 is, let us say, 20%. Probability of PI being 2 is, let us say, 13%, like this. So you're creating a risk profile. On that basis, you'll be taking a risk. Then the fourth method is risk-adjusted discount rate method. What happens? Present values are discounted to arrive at future cash flows are discounted to arrive at the present value. Now, this discount rate gets adjusted to reflect the project risk. That means if there are two projects, one project risk is more, another project risk is less. What will happen here? You'll be discounting at a risky rate. That means if project where risk is more, discount rate will be more. That is one more way of incorporating risk in your decision process. Certainty equivalent factors. The expected cash flow of the project are converted into certainty equivalents by applying suitable certainty equivalent coefficient. Then risk rate is applied for discount. What does it mean? Let me explain. So in every project, what we do, we compute first of all cash flows. And these cash flows are uncertain. What happens? Let us say you are expecting first year I will be getting 10 lakhs, but uncertain. I want to convert into certain. How much certainty? That means what is the certainty that I will be getting 10 lakhs? If it is uncertain, I will be multiplying it with the certainty equivalent factor. That is a certainty equivalent factor I am taking 0.7. If you multiply 10 lakh with 0.7, I will be getting 7 lakh. That means I am expecting there is a certainty. The 7 lakh is certain, 10 lakh is uncertain. So like this, so I need to find out, or night I need to estimate what is the certainty equivalent factor, which will be multiplied with the cash flows. And once it is multiplied, we'll be getting certain cash flows. Once cash flows are certain, then that has to be discounted. But here is a catch. That is not to be discounted with time value of money or cost of capital. That has to be discounted with the risk-free rate of, because cash flows are certain. Now risk is not. So this is one more method of estimating or analyzing risk. Okay, risk-adjusted discount method of I told you earlier. So what is risk-adjusted discount method? You can look at this slide. It is in fact risk-free rate of return plus risk premium. If project has got more risk, then risk premiums are added. What is certainty equivalent factor? What I explained to you, the same thing is explained in this slide. Okay, what will happen? Expected cash flows of the project are converted into certainty equivalent by applying suitable certainty equivalent coefficient. The certainty equivalent coefficient is a factor. Okay, just like I gave you an example, the 0.7 is to multiply. That is certainty equivalent factor. Fine. Well, friends, there is one more method of analyzing risk in project. That is called the decision tree. Okay, it is decision tree. Some of you might have heard it. Here, what Apple project is analyzed into various steps or various sequence of operations, various activities are considered. And these activities are drawn in a tree-like manner. That means the main activity, its branches like this is drawn. Each choices, that is each decision, is it treated as a different branch. And probabilities are attached to each decision. Then finally, cash flows are computed on the basis of this probability. It will be better if you look at this picture, you see. Let us say here is some decision has to be taken, two options, either to expand or not to expand. Okay, what is the probability of economic contraction, economic expansion? Here said, let us say 50% probability, 50% probability. So these are two branches. Now, once let us say economic contraction, okay, then further there is probability of, let us say, expansion, then contraction. There is a profit, there will be loss. So on the basis, let us say we are expanding, and there is economic expansion, then profit will be this one. We are expanding, there is economic contraction, loss will be this one. If we are not expanding, there is economic expansion, profit will be this one. If we are not expanding, economic contraction, loss will be this one. So like this, different branches are created for each decision. And these branches or these activities are evaluated in terms of cash flow and final decisions are taken. This is one method. Next method is called as the LP or linear programming model. Here what happens, linear programming statistical, it's a mathematical model. By using this model, what is the optimal solution of a problem is arrived at. In project decision also, what is the best solution that is arrived at by applying this LP model. Okay, so here what happens, the objective of the problem is defined. What are the limitations and restrictions are also defined. Conditions are identified. Then problem is solved by applying mathematical model. There are two models, primal model, dual model. Applying that model, applying this LP model, programs are solved. Problems are solved. The ninth method is simulation. Simulation means you can say it's a duplicate. It's a mathematical model which is construed and artificial data is fed to find out the solution. Okay, so this model is also used to find out that what is the risk involved in the project. Okay, so something very similar to the project is practically undertaken and find out what is the risk, what is the probability. This is called as the simulation. Sensitivity analysis is one more technique of risk analysis. It's also called as what if analysis. That means what will be the result if this thing happens? Or what will be the result if this thing else happens? Okay, suppose raw material prices goes up 10%, what will happen? Raw material price goes down 10%, what will happen? Let us say sales increases 10%, what will happen? So like this, by doing this analysis, one will be able to find out that whether project is sensitive or not. If it's sensitive, it is most sensitive to what aspects. On that basis, decisions are taken. Okay, under what happens under sensitivity and analysis? Then three possibilities or three situations. One is pessimistic. Let us say everything goes wrong. What will be the result? Then one estimated situation also come assume. That means everything happens fantastic. Then the most likely or realistic situation is also considered. So in three different situations, optimistic, pessimistic, and most likely situations are considered. On that basis, project's cash flow or profitability is arrived at. Okay, or net present value is arrived at. Finally, they applying this particular formula, it is decided what will be the expected net present value or expected profit. And the formula here is that P plus 4E plus O divided by 6. What does it mean? That means what? That means the probability, let us say we are calculating NPV. What is the what is the pessimistic NPV? What is the optimistic NPV? They are added. Plus, the most likely NPV is given weightage 4 times. Okay, pessimistic NPV is given weight of 1. Optimistic NPV is given weight of 1. And expected NPV or most likely NPV is given the weight of 4. Then when they're added, then totally they're divided with 6. So that it's a kind of averaging, you could say. Average NPV can be found out. This is called as sensitivity analysis. Okay, so in different situations, this can be also merged with decision tree. Here you can look at the see what is the optimistic situation, what is most likely situation, what is the pessimistic situation. Then considering all these things, here you see weight of 1, weight of 4, weight of 1. Then you can average it out and find out what is the desired situation, what is the most likely, what is the expected situation. Profitability distribution is another approach. The concept of profitability used for incurred risk in capital budgeting for projects. Okay, what happens here? The profitability distribution of cash flows over time provides valuable information about the expected value of the return and the dispersion of the profitability distribution of possible returns, which helps taking accept reject decisions in the investment decision. That means what happens here? On the basis of profitability, projects are analyzed and it is considered project is profitable, then what is the risk we are taking for that? Like this, on the basis of profitability, projects may be distributed. And one person is going for high profit, he should expect to take high return. On that basis, risk is analyzed. So these are, friends, various techniques we have seen, which are helpful in analyzing risk analysis in capital budgeting project. We'll stop here today. Thank you.